right here on ET Now, and let's connect with Jigar Mistry, co-founder at Buoyant Capital, right here on the show. Hi, Jigar. Good to be speaking with you, and the markets are also looking good because of late we are just building on to that gains. Believe that the worry around the Trump tariff tantrums as well as the slowdown, everything is just abating away. Give us some sense. What are you penciling in for the markets? And the bigger question is this up move sustainable? Share your thoughts.
Yes, good afternoon. Thank you as always for calling me to your show. I think it's a dichotomous situation, if I'm being honest, because see, clearly India is a macro darling in an otherwise turbulent world. But frankly, earnings sort of recovery is very elusive even as we speak. So if I sort of pencil in what we are looking at from a macro standpoint, then very clearly the CPI inflation is benign in India. We are around 4.5%. That looks fairly okay. Secondly, with the crude prices coming off and rupee appreciating, you are arguably looking at sort of a trillion INR in saving from the entire economic standpoint that would obviously get dispersed differently. And thirdly, sort of even the CAD sort of BOP is fairly stable. And that gives you an impression that in an otherwise volatile world, turbulent world, India stands out. However, that is not translating fully into how the earnings are panning out. So if I look at Nifty 4Q earnings, they are up like 7.5% YOY, but it was almost entirely driven by banks and lending institutions, right? Across the board, especially in the mid and small cap, the earning recovery is absolutely elusive, which is sort of a cause of concern for many of them. Secondly, if you look at the retail behavior, that's also very confounding because on one hand, there is more money coming into SIPs, but on the another, sort of if you look at the SIP cancellation number, that's at a fairly high number. And when you look at the demat account and do the analysis thereof, you find that there has been a direct selling that's going on, in the retail accounts, and the discontinuation in SIPs are the ones that opened in 2021, 2022. It eventually, I think, all boils down to sort of flows and not as much fundamentals. If you look at the rupee appreciation, then that means that FI money has returned back to India since about a month or so. Domestic liquidity continues to be high. And sadly, a lot of that money is again going into sort of all the narrative stocks, which is a little bit surprising. So net, I would say, flows are strong. Earnings have to catch up if we want to sustain at the levels that we are at.
All right. Hi, Jigar. This is Kanishka also joining in. While you did speak about the global factors at play and also earnings, but I want to get your broader view on earnings, like about the ongoing Q4 earnings season. Are there any early signs of upgrades or downgrades given how the earnings have been so far? Any particular sectors that you would like to discuss and help us understand that could see upgrades going forward?
Right. So see, this all sort of began from April to June quarter last year. Now, obviously, with the onset of general elections and given the large scale of that exercise, you started seeing a generic slowdown starting from that point. And we have almost completed the year with a single-digit growth on the headline indices. Now, the belief system, if you look at it, like one view of thought is that India, pretty much like we saw during COVID, right? In COVID, we didn't really report a FY20 drop and then in FY21 sort of relay back. Very similarly, one view of thought is that you should see the current situation in a similar light, which is that we don't really see the slowdown in F25 and then don't really talk about the run-up in F26, and we rather look at F24 to F26 and then sort of gauge on which sectors are doing well versus others. With that standpoint, optically speaking, F26 should start seeing some bit of recovery starting next quarter itself, because F20 sort of April, May, June last year was a washout quarter. That's one view of thought. The other view of thought is that we have actually entered sort of a structural issue which we need to understand. Obviously, if you look at the structure of the Indian markets compared to the US or say the Chinese markets, then there are sort of the tech firepower is not really at play. So when we did this analysis, sort of communication, discretionary track, sort of ownership has shrunk from to 13%, whereas that in the US is almost 40%, in China is almost 25%. Manufacturing, despite sort of whatever we are trying to do, is not moving above that 12 to 15% range, right? So unless you start seeing recovery in a lot of those sectors, it is difficult to believe on where the recovery would come from. That's point one. Point two, there is some sort of a shift even from the policy level in India, right? So India did phenomenally well to curtail the fiscal deficit from 4.9 to 4.4%, but that has come as by pushing the capex out. States, we analyzed the past 16 states that went into elections, and we noted that their sort of capex has slowed down, to 4.5% negative. Now, center and state capex and PSU was driving majority of the growth, and I think that might be a little more challenging now.
All right, Jigar, we do understand the data points that you are tracking at this point in time, but let's also talk sectors because we know we can't talk stocks then. But of late, that you have done in your portfolio, which sectors are looking good and which could be the likely underperformers as per you?
So the ones that we are very keen on are clearly sort of healthcare, especially pharmaceuticals, materials, specifically cement, increasingly chemicals is something that we are keenly interested in. And banking financials continue to remain very positive for us, but we were extremely overweight, and from that standpoint, we have sort of come off a little bit.
All right, Jigar, now that the banking and financial space remains your preferred pick still, could you help us understand, would you recommend rotating into large caps, or do you still sort of see value in the small and mid cap space?
Within financials, I think, there are two differences. I think one, the PSU banks, structurally, we don't think can match the ROA of the private sectors. And they have run up a little bit. We have also had our fair share of investments therein. So the ones that we continue to own are the ones in the sort of large cap private space, bar one or two in the PSU space. The MFI, we still don't think is fully out of the woods yet, and had it not been for the sort of, the freebies that the state governments offered, then you would have seen an even worse of picture. So net, to answer your question, I think large caps and privates are the ones that we are more positive on.
You just touched upon the pharma space as well. What exactly are you looking at when it comes to pharma plays? The reason I'm asking is, well, of course, all these export-oriented generic companies are a bit under pressure on the back of this tariff tantrum, and companies, what we get to hear, are still waiting for that clarity to kick in. But on the other side, the CDMO plays are doing very well. One of the stocks is also up around 6%, one of the leaders rather. So which segment within pharma space is looking good to you?
Both those, in fact. So if you look at pure play generics, then I think if you look at what Trump is trying to say and sort of the implications that we understand thereof are two different things. I think if you want to reduce the pricing of pharmaceutical drugs in the US, then taxing generics is not the way to go. And I think it's been very clear there. And the price at which we deliver the generics from India is not really that expensive. So net, I don't, and they obviously have been kept out so far. So we don't think that is changing, and these are the places that we continue to like. Even the ones in the CDMO space, for example, the one that you also mentioned, I think we continue to, that's part of our portfolio. We continue to remain reasonably positive thereon. And this is the space, you need to create a structure where the PBMs are not as prominent, the end players are not as sort of consolidated as they are, and then you can start deliver the benefits to the final consumer. And attacking the Indian pharma space, I don't think is the way out of that.
Okay. Jigar, lastly, I also want to understand your take on current valuations. Now, how are you viewing them? Are they really high, or do you think they have become reasonable now? And given the current valuations, are you advising a more bottoms-up stock picking, or one should go for thematic investing?
So I would say it's the end of February, we had taken out a large part of froth that was built up. By September 2024, that is last year, you saw especially in the small and micro cap space, the earnings were growing at 14% CAGR for 3 years. Share prices had grown 26%. So there was a 12% compounded froth times 3 years that needed to be taken out. By the end of February, even sort of some bits in March, you saw a large part of that fall into place very well. But since then, I think sort of markets have reverted back. We have had among the best 2 months USD returns post COVID in those 2 months. And I think the valuations are looking elevated, especially a lot of these narrative stocks which lack earning. So our sense is that you are going to see cycles which are very, very sharp. Valuations eventually, or rather flows eventually, don't drive fundamentals. It's normally the other way around, especially in the longer term. So we are continuing to remain a lot more focused on earnings and a lot less on where sort of narratives come. Now, one of those stocks you did see today on how, sort of one government contract cancellation and you realize that 50 to 70% of the earnings go away. That risk needs to be priced in, and I don't think people are fully aware and pricing those risks in.
Yeah. Okay. Thank you so much for those views, Jigar. With that, we'll let you go. So good to have you. Thanks for your time. And